Hey everyone, ready for a deep dive into something really interesting? Today we're looking at a financial report that's causing a lot of buzz, and get this, it's coming all the way from China.
Yeah, that's right.
It's actually written in Chinese.
You got it.
But don't worry, we've got the highlights for you. No need to brush up on your Mandarin for this deep dive.
That's right.
So what's got everyone talking is the report's premise. It imagines a second term for Donald Trump and how that could impact the global markets from 2025 to 2029.
Yeah, it's a fascinating thought experiment, isn't it? They're taking what we know about his policies from his first term and using that to sort of project, potential market movements.
Sort of like a what-if scenario for investors?
Exactly.
Okay, so let's unpack this. The report focuses on some key policy areas: tax cuts, infrastructure spending, inflation, the U.S. dollar trade, and energy. Where do we even begin with all that?
Well, why don't we start with one that's likely to have a pretty big impact? Tax cuts. The report suggests that a second Trump administration might double down on the tax cuts we saw in his first term, potentially cutting corporate and individual income taxes even further.
Okay, so if we follow that logic, wouldn't that mean more money in the pockets of businesses and individuals?
That's the thinking. And the report suggests this could be a big boost for certain segments of the U.S. stock market. Specifically, they highlight the potential for growth stocks to really take off.
Growth stocks. Can you help me out here? Why would those be particularly well-positioned in this scenario?
Sure, think about it this way. If companies are paying less in taxes, they're likely to have more profits, right? And growth stocks represent companies that are expected to grow their earnings at an above-average rate. So the idea is that those increased profits fueled by tax cuts could supercharge the growth of these companies.
Ah, I see. So the report is essentially betting that a pro-growth, low-tax environment would create a favorable climate for companies that are already on a strong growth trajectory.
Exactly. And they even point to some specific exchange-traded funds or ETFs that could benefit from this trend. They mention the Vanguard Total World Stock ETF, known by its ticker VT, and the Vanguard Total Stock Market ETF, which is VTI. Both of these ETFs provide broad exposure to a wide range of growth stocks.
Okay, so the report is bullish on growth stocks, but they also point out the potential downside of tax cuts, right? Didn't they mention something about the U.S. deficit?
Yeah, they did. The report acknowledges that while tax cuts can stimulate economic growth, they can also lead to an increase in the U.S. deficit. It's a classic trade-off that policymakers have to weigh.
So more growth potential, but also the potential for more debt. It's a delicate balancing act.
Exactly, and that's one of the things that makes this report so interesting. It doesn't shy away from highlighting both the potential benefits and the risks of these policies.
That's a good point. So we've got this potential boost for growth stocks, but we also have to consider the bigger picture. What else does the report flag as a potential game changer in a second Trump term?
Well, one area that really stands out is trade. You might recall that trade tensions, particularly between the U.S. and China, were a major theme during Trump's first term.
Oh yeah, things got pretty heated on that front. Lots of tariffs flying back and forth. What does the report say about how that might play out in a second term?
They seem to think there's a real possibility of those tensions escalating even more so than before. And that could have some significant implications for the global market. Think about it. Trade wars can disrupt supply chains, increase costs for businesses, and ultimately lead to slower economic growth.
So even if we see this initial boost from tax cuts, those gains could be wiped out if trade wars start raging across the globe.
That's one of the scenarios the report explores. And it highlights the potential impact on international investments, particularly in emerging markets. They specifically mention the Vanguard Total International Stock ETF, also known as VXUS, as a potential area of concern in this scenario.
Wow, so for anyone with a lot of international stock in their portfolio, this is where things could get really interesting, right? They'd be right in the middle of this tug-of-war between the U.S. and China.
You got it. It's a reminder that investing always comes with risks, and geopolitical risks are something investors have to be aware of, especially when it comes to global markets.
So we've got potential growth from tax cuts, but also potential volatility from trade wars. It's a complex equation, but I'm starting to get a sense of how these different factors could play out.
Yeah, it's all about understanding the potential domino effects. One policy change can trigger a whole chain of events, and that's what this report is trying to map out.
Fascinating. Okay, let's keep going. The report also highlighted high dividend stocks as a potential bright spot. I remember them mentioning the Yuan to Taiwan Top 50 ETF, which has the ticker 00056, and the Cathay Sustainable High Dividend ETF, ticker 000878. What's the thinking there? Why would these ETFs be particularly attractive in a second Trump term?
Good catch. You're right, the report does spend some time on high dividend stocks, and it gets really interesting when you connect it back to another policy area, infrastructure. The report suggests that a second Trump administration might prioritize infrastructure spending, potentially leading to increased demand for construction materials, energy, and other related industries.
Okay, I'm starting to see the connection. If those industries are doing well, wouldn't that translate into higher profits for companies in those sectors? And wouldn't those companies then be more likely to pay out higher dividends to their shareholders?
Exactly. And that's where those two ETFs you mentioned come in. The Yuan Taiwan Top 50 ETF has significant exposure to Taiwanese companies, many of which are involved in infrastructure and manufacturing. And the Cathay Sustainable High Dividend ETF focuses on companies with a history of paying high dividends, including those in the energy and industrial sectors.
Ah, I see. So the report is essentially saying that these ETFs could offer investors a way to tap into the potential growth of infrastructure-related industries.
That's a great way to put it. They're suggesting that these ETFs could be a potential source of both growth and income, a combination that could be particularly appealing to investors.
Okay, so we've got growth stocks, we've got high dividend stocks. But what about bonds? I mean, those are usually considered a core part of any diversified portfolio.
You're absolutely right, and the report definitely doesn't forget about bonds, but they do highlight one very important consideration when it comes to bonds in this scenario: inflation.
Right, inflation. It seems like everyone's talking about inflation these days, and I know it can have a big impact on bond returns.
You're exactly right. When inflation rises, the purchasing power of your money decreases. And since bonds typically pay a fixed rate of interest, that fixed return can be eroded by inflation.
So the report is essentially saying that we need to think carefully about bonds if we're anticipating a potential uptick in inflation under a second Trump term.
Precisely. They suggest paying close attention to something called bond duration, which is a measure of a bond's sensitivity to changes in interest rates.
Bond duration. Okay, I'm going to need a little help on that one. Can you break that down for me?
Of course. In simple terms, bond duration tells you how much a bond's price is likely to change if interest rates move up or down. Longer-term bonds typically have a higher duration, meaning their prices are more sensitive to interest rate changes. Short-term bonds, on the other hand, have a lower duration, so their prices are less affected by interest rate movements.
Okay, I'm starting to get it. So what does that mean for investors in this scenario? Which type of bond should they be considering?
The report suggests that if inflation heats up shorter-term bonds, might be a safer bet than longer-term bonds. They even point to specific ETFs that could fit this bill. For example, they mentioned the Yuan U.S. Treasury 1-to-3-year bond ETF, known by its ticker 00719B. This ETF invests in short-term U.S. Treasury bonds, which are considered to be very low risk.
So if you're worried about inflation eating into your bond returns, short-term bonds might be the way to go.
That's the thinking. It's all about managing risk and finding investments that are likely to hold their value in a variety of economic conditions.
This is all really interesting, but we've covered a lot of ground already. I think we need to pause here and take a breather. We've only just scratched the surface of this report, and I can already tell it's packed with insights.
I agree, we've covered a lot, but we're just getting started. There's so much more to explore in this report, and I'm eager to dive back in. Join us for part 2, where we'll unpack the specific asset allocations and strategies recommended for this hypothetical second Trump term.
Welcome back. Still processing all those potential impacts we discussed in part 1, but I'm ready to keep going with this deep dive. We left off talking about bonds, specifically how they might be affected by inflation under a second Trump administration.
Yeah, it's definitely a key consideration, especially since the report suggests a potential uptick in inflation if some of those policies we discussed come to pass.
Right, and I remember them mentioning the Yuan U.S. Treasury 1-to-3-year bond ETF, or 0000719B, as a potential option for navigating that tricky environment.
Exactly. Short-term bonds like those in that ETF can be a good way to mitigate inflation risk because their prices tend to be less sensitive to interest rate changes, which often go hand in hand with rising inflation.
Okay, that makes sense. So we've got short-term bonds as a potential play in a second Trump term. But before we move on, there's one other asset class I wanted to touch on. Cash. I noticed the report recommends keeping 15% of the portfolio in cash, 10% in US dollars, and 5% in new Taiwan dollars. I'm curious about the logic behind that.
It's a great question, and it speaks to the report's emphasis on both flexibility and hedging. Holding cash, especially in US dollars, can be a smart move if you think the dollar is going to strengthen against other currencies.
Yeah.
That's actually one of the predictions the report makes. They see the potential for a stronger US dollar under a second Trump administration.
So if the dollar goes up in value, that means your US dollar holdings would be worth more.
Precisely. It's like getting a bonus just for holding on to your cash. But there's another layer to this strategy. The report also recommends holding a portion of that cash in new Taiwan dollars.
Okay, I'm intrigued. Why new Taiwan dollars specifically?
It's all about diversification and hedging against currency risk. If you're holding assets in different currencies, it can help to smooth out the ups and downs of the market. For example, if the US dollar weakens, the new Taiwan dollar might strengthen or at least hold its value better.
So it's about spreading your bets and not putting all your eggs in one currency basket.
Exactly. It's like having a backup plan for your cash, just in case one currency takes an unexpected turn.
I like it. It seems like this report is all about strategic thinking and being prepared for a variety of potential outcomes.
Absolutely. It's not just about picking the right investments. It's about having a plan in place for managing risk and navigating whatever the market throws your way.
Well said. Okay, I think we've covered all the major asset classes now. But remember, this report isn't just about individual investments, it's about building a cohesive portfolio. So let's dive into the actual allocation they recommend for this hypothetical second Trump term.
Right.
Where do they suggest putting all these pieces together?
They propose a portfolio with a 40% allocation to growth stocks, 30% to high dividend stocks, 15% to bonds, and 15% to cash.
Okay, so a pretty significant chunk dedicated to growth stocks, which aligns with their prediction that those could perform well in this scenario. But I'm noticing that they're also recommending a good chunk of high dividend stocks. Why such a large allocation to those?
It's a strategic move for a couple of reasons. First, as we discussed earlier, they see potential for those infrastructure and energy plays to really take off, potentially leading to higher dividends for investors. But it's also about balancing risk and providing a source of steady income, especially if those growth stocks experience some bumps along the way.
Right, those high dividend stocks could act as a bit of a cushion if the market gets choppy. And of course, we've already talked about why they're recommending short-term bonds and a mix of US dollars and new Taiwan dollars for the cash portion. It seems like they're trying to cover all their bases here.
Exactly. It's a well-diversified portfolio designed to weather a variety of potential storms. But remember, diversification is just one piece of the puzzle. The report also emphasizes the importance of staying dynamic and making adjustments as needed.
That makes sense. After all, this is a hypothetical scenario based on a lot of assumptions. Things could easily play out differently in the real world.
Absolutely. And that's why the report stresses the need for ongoing monitoring and adjustment. It's not a set-it-and-forget-it strategy. Investors need to stay informed about what's happening in the market and be prepared to make changes to their portfolio as needed.
Okay, so we've got the portfolio allocation, we've got the emphasis on staying dynamic, but there's one more crucial element I wanted to address: inflation. The report actually goes a step further and calculates adjusted returns for each asset class, taking into account a hypothetical average annual inflation rate of 2.5%.
That's a really important point. It's not enough to just look at raw returns. We need to consider what those returns actually mean in terms of purchasing power. If inflation is eating away at your gains, you're not really coming out ahead.
Exactly. So let's dive into those inflation-adjusted returns. What does the report reveal about how different asset classes might perform in a world with 2.5% annual inflation?
The findings are quite insightful. According to their calculations, growth stocks, as represented by ETFs like VT and VTI, still show strong potential even after factoring in inflation.
So even if prices are rising, those growth companies might still be able to generate returns that outpace inflation.
That's the idea. They're betting on those companies' ability to grow their earnings at a rate that exceeds the rate of inflation.
Okay, that makes sense. What about high dividend stocks? How do those fare in this inflation-adjusted scenario?
They also show resilience, but their real returns are somewhat muted compared to growth stocks.
So still a viable option, but maybe not the top performer in this scenario.
Right. The steady income from dividends can help to offset some of the impact of inflation, but it might not be enough to completely outpace it.
Okay, that makes sense. Now let's talk bonds. We know they can be sensitive to inflation. What does the report say about their performance in this adjusted scenario?
The report shows that bonds, especially long-term bonds, like those in the 00679B ETF we mentioned earlier, take a significant hit from inflation.
So if you're holding long-term bonds and inflation picks up, you might see your purchasing power erode faster than you'd like. That's a real risk to consider.
It is, and it highlights why the report suggests sticking with those short-term bonds if inflation is a concern.
Okay, so short-term bonds for inflation protection. What about cash? How does that fare in a world with 2.5% annual inflation?
Unfortunately, the report doesn't paint a rosy picture for cash in this scenario. With inflation at that level, both U.S. dollars and new Taiwan dollars experience negative real returns. Essentially, you're losing purchasing power over time if you're just holding on to cash.
Wow, that's a sobering thought. It really highlights the importance of investing strategically, even if you're risk-averse. Just parking your money in cash might feel safe, but it's not a guaranteed way to preserve your wealth, especially when inflation is a factor.
Exactly. This report really drives that point home. It encourages investors to think beyond nominal returns and focus on the real purchasing power of their investments.
Well said. Okay, so we've covered a lot of ground here. The potential impact of a second Trump term, the proposed asset allocation strategy, and even the crucial adjustments for inflation.
It's been quite a deep dive, packed with insights. But we're not done yet. There's still more to explore in this fascinating report, particularly when it comes to navigating this complex landscape.
You're right. Join us for part 3, where we'll uncover the specific strategies the report recommends for managing risk, staying flexible, and adapting to whatever a second Trump term might bring. Welcome back for the final part of our deep dive. We've talked about this report's predictions, their proposed investment portfolio, and even factored in inflation. But what I'm really curious about is how we actually put all this knowledge into action.
Yeah, that's where this report really shines. It's not just about throwing out investment ideas. It's about giving you a framework for navigating a potentially volatile market. Think of it as a roadmap for a second Trump term with all its twists and turns.
Okay, I like that analogy. So what are some of the key strategies they highlight for staying ahead of the curve?
One of the most important and often overlooked strategies is simply staying informed. The report emphasizes monitoring economic data, like interest rates and inflation. These are key indicators that can signal shifts in the market and help you anticipate potential changes.
So it's not just set it and forget it. We've got to stay engaged and keep our finger on the pulse of the economy.
Exactly. You need to be aware of the factors that could influence your investments and be ready to adjust your strategy accordingly. The report calls this a dynamic approach to investing.
Makes sense. So staying informed, being dynamic. What else?
They also highlight the power of dollar cost averaging. It's a simple but incredibly effective strategy, especially when you're dealing with a lot of uncertainty.
I've heard of dollar cost averaging, but can you remind me how it works?
Sure. Instead of trying to time the market perfectly, which is nearly impossible even for seasoned investors, you invest consistently over time, regardless of whether the market is up or down.
So you're basically taking the emotion out of it and sticking to a regular investment schedule.
Exactly. By investing a set amount at regular intervals, you're essentially buying more shares when prices are low and fewer shares when prices are high. Over time, this can help to lower your average cost per share and smooth out the volatility of the market.
Okay, I see how that could be really helpful, especially if we're anticipating a potentially turbulent market under a second Trump term. It's like taking a steady, disciplined approach instead of getting caught up in the daily ups and downs.
You've got it. It's about playing the long game and not letting short-term market fluctuations derail your investment plan.
This is great. Any other strategies they highlight for navigating this potential market landscape?
Yes. One more that's particularly relevant given the potential for trade tensions and currency fluctuations. Hedging.
Hedging. Now that's a term that can sound a bit intimidating. Can you break that down for me in simple terms?
Of course. Think of hedging as a way to protect your investments against potential losses. In this case, losses due to unfavorable currency movements. Imagine, for example, that you're holding international stocks in your portfolio and the U.S. dollar strengthens significantly.
Right, we talked about that earlier. The report predicts a potential strengthening of the U.S. dollar under a second Trump administration.
Exactly. So if the dollar strengthens, your international holdings would be worth less when converted back into U.S. dollars. Hedging can help to offset some of those potential losses.
Okay, so it's like an insurance policy for your international investments. You're mitigating the risk of currency fluctuations eating into your returns.
That's a great way to think about it. There are various ways to hedge, but the goal is to minimize the impact of those currency movements on your overall portfolio.
It seems like this report is really arming investors with the knowledge and strategies they need to navigate a potentially challenging market.
Absolutely. It's about taking a proactive approach, being aware of the risks, and having a plan in place to adapt to whatever comes your way.
This has been a really insightful deep dive. We explored so many different facets of this report, from the potential impacts of a second Trump term to the specific investment strategies they recommend for navigating this landscape.
Yeah, it's been a fascinating journey, and I hope our listeners are walking away with a better understanding of how political events can ripple through the financial markets and what steps they can take to prepare and adapt.
Absolutely. Remember, this report is just one perspective, and it's based on a lot of assumptions, but it's a great starting point for thinking critically about how your investments might be affected by the political and economic landscape.
Couldn't agree more. It's all about doing your research, staying informed, and making decisions that align with your own financial goals and risk tolerance.
Well said. All right, folks, that brings our deep dive to a close. We hope you found this exploration insightful and thought-provoking. Remember, knowledge is power, and the more informed you are, the better equipped you'll be to make sound financial decisions no matter what the future holds.
Until next time, happy investing.
And keep exploring. We'll be back soon with another deep dive into a topic that's sure to spark your curiosity.